JEPI and JEPQ are two of the most popular income ETFs on the planet, but almost no one's talking about what they pay after tax. So I put $10,000 into each one of them, and we're going to see exactly the dollar amount that lands in your brokerage account every month. So let's get right into it. And if you appreciate this type of content, be sure to subscribe on the way in, and let's get started. Without going too far into the weeds, at a high level, JEPI and JEPQ are both from JP Morgan. JEPI has been around since 2020 with S&P 500 exposure and about $45.2 billion in assets under management. And JEPQ has been around since 2022 with NASDAQ 100 exposure and a little bit smaller with $40.4 billion in assets under management. So combined, these two have about $85.6 billion in assets under management. Now let's talk about why the return of capital percentage isn't what it looks like. So these funds sell options called equity-linked notes, and the options income is classified as return of capital. So in YieldCanary, you'll see both of these funds carry the Tax-Efficient ROC badge, and that means that the high return of capital percentage you'll see, especially on JEPQ, isn't causing NAV erosion. The NAV has held up on both of these funds, and that distinguishes the kind of ROC on these funds that you'll see on the destructive kind from yield trap funds. But we'll get into that in just a minute. Quick health check on JEPI and JEPQ. So for true income yield, this is subtracting out the destructive return of capital. JEPI is sitting at an 8.05% true income yield, and JEPQ at a 10.51%. And then we have the advertised yield, which is the most recent distribution annualized. That for JEPQ is sitting at 8.22% and 13.06% for JEPQ. Then we have the return of capital. Like I said before, this is not destructive return of capital. JEPI at 17.62% and JEPQ at 64.20%. And both of these have a canary status of healthy within the YieldCanary platform. So enough with the boring stuff. Let's get into actually building out the portfolio. And we're going to model three different scenarios. The first one is $10,000 in each, which I went ahead and did already. We are on the portfolio tab of YieldCanary. Let me zoom in. And hopefully you could see that a little bit better, but you could see the total portfolio value just over 20,000. The weighted true income yield between the two here, 9.28%. And what I did was added 177 shares of JEPI, 170 shares of JEPQ. You could see the positions are a little over $10,000. And the estimated monthly income after tax is $124. The taxes are set to 25%. In this example, you can change that up in the profile settings of YieldCanary in the top right. And this is going to be $1,484 per year in after tax income. So that is modeling a 10,000 in each of these. What we're going to do now is we're going to put 50,000 into each of these and see what that does to the numbers. So for JEPI, we are going to increase this share count from 177 to 885 shares and click save. And then we're going to do the same thing to JEPQ with 847 shares. Hit save. All of this will update automatically. You can see the positions now are a little over 50,000 in each. And if we come back up, the portfolio value, just a little over 100,000. And now we have a new estimated monthly income of $617, which is $7,402 in after-tax income. This breaks down to JEPI distributing $258 per month after tax, and JEPQ is at $362 per month in after tax income. So that's $50,000 in each. Let's take it one step further. we're going to put 100,000 in each of these to see what our numbers look like. So let's update the shares on JEPI, and we will update the shares on JEPQ as well. And 1,694 shares. So you could see total portfolio value now is just over $200,000, and we have an estimated monthly income of $1,233, which would be about $14,798 per year in after-tax income. So JEPI is winning the income battle between these two, just because the NASDAQ is a little more volatile, so the premiums collected there are a little bit greater. But there is a trade-off. You know, JEPQ is heavy in the tech sector, so if the NASDAQ has a bad month, you will see a difference between these two. So let's summarize what we just modeled. 10,000 in each. You're going to have $52 per month coming from JEPI and $72 per month from JEPQ. 50,000 in each, $258 from JEPI, $362 from JEPQ, and $100,000 in each. You have $517 from JEPI and $724 from JEPQ in monthly after-tax income. Now, nothing is set in stone. Things can change from month to month. A few factors: distributions vary with market volatility. A high VIX pays more. The tax rate shown in this example is set to 25%. If you were in something like a Roth IRA, it is obviously tax-free. In the taxable accounts, it's ordinary income. So if you were in a Roth IRA, you could set your tax rate in YieldCanary to 0% to model that scenario. And finally, these numbers reflect last month's actual distributions. So going forward, these numbers are obviously not a guarantee, but both funds have been paying monthly since the launch with no interruptions. So to summarize the main point of this video, $10,000 into both JEPI and JEPQ. JEPI's paying $52 a month at an 8% true income yield, and JEPQ paying $72 a month at a 10.5% true income yield. That combined is $124 a month, or about $14.88 per year. And both of these funds are obviously healthy, and both are carrying the tax-efficient ROC badge in YieldCanary. If you want to run these numbers at your own tax rate, if you want to check the health on any fund that you're holding, or see what your portfolio is generating in monthly after-tax revenue and income, you could try YieldCanary for free today. There is a pinned comment down below. Make sure you subscribe on your way out. Leave a comment down there. Let me know if you agree or disagree with what I'm saying, and we'll catch you in the next video.